Welcome back to the channel, everyone. This is Mo Investing, and we keep things short and sweet, so let's jump straight in. FICO, famous for the FICO score, has shown some chinks in their armor as of late, attracting regulatory scrutiny after aggressive price increases and also competition heating up. So, what's the story with FICO? Let's firstly look at the business. FICO's business is essentially split into two: their FICO score business as well as their software business. And then, crucially, with their software business, they have customers on their legacy services which they're trying to move across to their new FICO platform, which is their cloud-based platform that they include all their services on. So think things like fraud detection, decision management, and things like that. So they're trying to move customers across. So that's also reflected in their earnings, which we'll see later on. Looking at the numbers, FICO's market cap sits at 25 billion with the gross margin sitting at 82%. FICO is a capital light business where most of the operating cash flow does flow to the bottom line, so that's something to consider. Their trailing 12-month PE is at 40, with their next 12-month PE at 23, and then their 2027 PE sits at 20. The stock price of FICO is at 1,100 right now as of the recording of this video. Now, FICO stock price is down 32% year to date and 39% in the last year. Now, there's a couple of reasons for this. FICO has shown a couple of weaknesses or concerns over the last couple of years. They've attracted regulatory scrutiny through their price increases. They've also lost exclusivity on the mortgage lending space with the FICO score. So the Federal Housing Finance Agency actually approved the use of both FICO and Vantage score models for mortgage lending, ending FICO's 30-year dominance, which also leaves Vantage score becoming more of a competitor, affecting FICO's pricing power when it comes to score pricing, with the three credit bureaus which are responsible for creating the Vantage score trying to undercut FICO's prices as well. Now, FICO's trying to combat their reliance on the credit bureaus for the distribution of the FICO score through using their mortgage direct licensing program. This allows them to directly sell their scores to lenders, benefiting them in pricing transparency and cost savings, as well as reducing their breakage fees. So FICO is trying to become more independent and circumvent the middleman and directly sell to the lender in this case. Now, looking at FICO's Q1 earnings, they were pretty good. Revenues up 16% year on year. Scores revenue is up 29% year on year, and software revenue is up 2% year on year. But this is a reflection of their customers moving from the legacy on-premise software to their FICO platform. And then FICO is continuing to buy back shares aggressively. They even take out debt. They have a program where they do take out debt to buy back shares as well. So they're continuing on with that. In terms of outlook for 2026, it does look pretty good. Their revenue, they're guiding for 2.35 billion in revenue, an 18% year-on-year increase. And then their net income, they're guiding for 795 million, a 22% year-on-year increase. And for earnings per share, they're guiding for $33.7, which is a 26% year-on-year increase. Moving on to the valuation and moat of FICO. So starting off with the moat, FICO's real moat has been their pricing power. They have been pretty much virtually uncontested in the credit scoring space. And at this point, they're deeply integrated and the standard within financial institutions, banks, and with lenders. So they're pretty much immovable at this point. They're deeply embedded in all the systems, and their software also does boast high switching costs, especially when dealing with financial institutions. It's a tall task to ask them to move to different software, as there's huge financial hurdles to that. So far I would say FICO's moat is still intact. There are concerns with the regulators and Vantage score becoming more of a competitor, but FICO is deeply integrated, and I don't see these concerns really taking effect for a couple more years, and it remains to be seen if they actually do impact FICO at all. Finally, onto valuation. Now, FICO has been consistently growing revenue and EPS for many years. So for our base case, we're going to take into consideration analyst expectations. So in terms of EPS, analysts expect the EPS to be at around $82 in 2030, which equates to about a 25% CAGR. So we'll take that into consideration in our DCF calculation. And here on Qualtrim, we'll actually reduce the EPS growth. We'll say FICO grows at a 20% CAGR and we'll give it an exit multiple of 25, and I think that's kind of reasonable. So we can see here that the price of FICO could end up being by 2031 1.6k. So decent, not crazy growth. In terms of rating, I'm going to give FICO a rating of 4 on account of their moat still being intact but under threat slightly. And then in terms of verdict, we'll give FICO a verdict of a hold, in my opinion. The returns aren't nice enough at this point. If the valuation does drop even more, it could become very attractive, but I don't think the returns right now are worth it. So I think it's a hold if you own FICO right now, but I wouldn't consider it a buy. Okay, so that's it for the video. Let me know if you like the new style of stock analysis, if I should continue it on like this or make any changes. And thanks for watching, and I'll see you in the next one.